And we are going to stick with commodities, one in particular, natural gas prices. We showed you that chart earlier, hovering around a 10-year low. Our next guest says that what is happening out there creates the perfect storm. And as we've been talking, a rip-your-face-off rally in the commodity. Joining us from the Nasdaq to give his predictions is JC Parets, founder of allstarcharts.com. Good morning, JC. Thanks very much for joining us. For those people who don't know, what is a rip-your-face-off rally?
Well, we think this trade is very intriguing for a lot of reasons. You know, it's been crashing for 3.5 years now, and there's really no bottom in sight, and there's a lot of pessimism out there. So we think that the reversion to the mean trade could get going at some point in the near future, for the simple fact that we're down 80% in natural gas prices over the last 3.5 years, and the historical moving averages are substantially higher than current prices. So when the reversion to the mean trade begins, whether it's next week, next month, or in a couple of months, I think it happens sooner than later. But when it does occur, it's going to come quick, and it's going to come, real fast.
Why would there be a reversion to the mean trade? Because people have been calling for that or expecting it, saying whether it's a day or a month or a few months from now, for several months. We're looking at a commodity sitting at its lowest in 10 years. You just gave the numbers yourself from its highs back in 2008. Is there a catalyst that will set up the change that you are anticipating?
Well, my fundamental buddies tell me that a combination of the fact that we have more natural gas in this country than we know what to do with. Donald Trump came out recently and said that the United States is a Saudi Arabia of natural gas. The mild winter that we're seeing isn't helping things either. And I'm a technician, and when a fundamentalist tells me this sort of thing, I pretty much figured that already, so it's nothing new. So a lot of these things are already priced into the market, and in the history of natural gas, go back 80, 90 years, at one point or another, that reversion to the mean process has begun, whether prices are substantially above the mean or substantially below. At this point, we're sitting at somewhere around 50% below the 200-day moving average in natural gas. So we think that we're still in the camp that we're going to see fresh lows in natural gas, but I think that those will be short and sweet and is going to provide us with an excellent entry point.
You make an interesting point in some of your comments that it's a little bit different looking at a commodity versus a stock. Quite frankly, a stock can go to zero. I guess a commodity can as well, but it's highly unlikely. It's not going to go bankrupt, a commodity. What are some of the other metrics? You mentioned the 200-day, how far below we are. I think you also look at Fibonacci numbers and the like. Give us some context there. So for certainly technical viewers, technical analyst viewers that we have, I know, can look at your numbers and say where the trigger points might be.
Sure. Well, let's keep it simple and let's just compare it to crude oil. Over the last 20 years, the average ratio between crude oil and natural gas has been somewhere in the neighborhood of 10 to 1, ranging from a low of 7.5, 8 to 1 to as high as 13.5, 14 to 1, but around 10 to 1. We're currently sitting above 40 to 1. So we need to ask ourselves a question. Is this a new normal? Is this something that we need to get used to? These crude oil prices, exponentially higher than natural gas for a sustained period of time? Is that something new that we need to get used to? We're in the camp that that's not the case at all, that we'll revert to historical means. And I'm not smart enough to tell you that that's going to happen tomorrow or next week or next month. But when that reversion to that mean gets going, it's going to be vicious. And if you're on the wrong side of that trade, you're going to get squeezed. But if you're on the right side of the trade, you're going to do very well.
Are you willing?
I think from...
I'm sorry, JC, are you willing then to, let's say, is it a 5% move to the upside off of some low? What is that trigger point? You're going to have to give up something when it turns. I know it's going to turn fast, but you don't want to also get in too early as it goes to $2.
That's a great point, and that's actually an excellent question. First of all, so what's the target? We're in not just a reversion to the mean business, but we are in a reversion beyond the mean business. So in other words, sure, the 200-day moving average is 45, 50% higher than what we currently are, but we often see the prices exceed those historical means by another 10, 20%, sometimes even more. So the upside is tremendous. We can potentially see a double in natural gas prices in a very short period of time. But on the flip side, the most important thing here is to manage risk. That's really what makes this trade so attractive. Not just the profit potential if we're right, but to position ourselves so that if we're wrong, it's not that big of a deal. So if we do see that rollover that we're looking for, we do see those fresh lows, we're going to see some sort of reversal. Whether it happens over a weekend or whether it happens overnight, happens intraday, we're going to see a reversal where fresh lows are made and those fresh lows cannot be sustained. So that's going to trigger a lot of stop losses. It's going to trigger a lot of new shorts because there are a lot of them out there. So if that does occur and we start to, turn back up, very similar to what happened in gold at the end of last year, we saw that false breakdown over the holidays, and come the new year, we start seeing new highs like those lows never happened. And sure enough, over the last 2 months, silver and gold are some of the best performing asset classes on earth. I think the potential in natural gas is similar, different in the fact that gold has already been in an uptrend for 10 years and natural gas, can't find a bottom. However, that makes the upside potential that much more attractive. But you can't forget about the risk management. When we do enter our positions, because we don't have any positions at this point, when we do see an entry point, we want a pivot point, a fixed level where we know we're wrong. If we make new lows, all bets are off, and we can always re-enter in the future.
JC, let me jump in right there. For your average equity investor, a retail investor who's watching you right now, doesn't usually buy or sell commodity futures, is there a way to play what you're saying through the equity markets some way? Is there an ETF? Is there something that they could then do their own homework on if they like the argument that you're laying out?
Yeah, that's a great point, and it is difficult for the retail investors to get involved in the natural gas space because really UNG is really the ETF that comes to mind, and it's not everyone's favorite ETF. It's very disliked out there because of the contango situation. It underperforms the commodity. But it's liquid. You can get involved, and if you can buy it at 17 and a half with a fixed stop, 25, 50 cents below your entry point, where if we're right, you have a 200-day moving average in UNG, which is the United States Natural Gas Fund, somewhere around $35. So if you can get in at 17 and a half with a 200-day moving average at 35, that's tremendous upside potential with a fixed amount of risk where we'll know we're wrong very, very early. Risk 2, 3, 3.5%. Is that the end of the world if we're wrong? No, I don't think so. But it is important to manage risk, especially in an asset class that's been crashing for 3.5 years.
JC, great color and great commentary, including the risk management side of the trade. Thank you very much for joining us this morning.
Thanks for having me. JC
Parets, founder, allstarcharts.com, and we're going to post on bnn.ca the actual definition of a rip your face off trade.
Face ripper. A face ripper, according to the Oxford English, well, it's not Oxford English Dictionary, a face ripper. Noun, a market advance with extreme intensity, so much so that it takes skin and hair along with it from the facial area. Difficult to detect in advance, but upon arrival, the feeling is instantaneously recognized.
And that's how JC kind of put it that way in technical terms.